welcome students, welcome to Abhigyan Academy. This side Apurva Nandi. As I have started the series of economy in the platform that you are continuously watching. So today our topic is the monetary policy. Okay. Before starting with the topic monetary policy, let me discuss a very basic topic which is known as the money supply. In my earlier videos, I have talked about the money supply. That means the supply of money in the economy. Ki, as the income rise, this income can also be said as money supply. In the economy, the amount of money, if it increases, how the economy in economy money increases? Definitely via the mode of income. Income increase means money supply increase. It results into the rise in demand. And when demand rises, inflation in the economy takes place. In other words, if money supply in the economy decreases, that means the income of the people is also less. That means there will be a fall in demand. That means people will demand very less goods, which will mean less production, which will means less production. Because there is very less demand, then there will be very less production, which will result into economic stagnation. Okay, the economy may stagnate. Okay, there will be less or no economic growth, which is again bad for the economy. All right, that means high economic growth means high inflation, low economic growth means low inflation. In this phase, there will be low inflation. All right, now if we have to keep the inflation in check, or if we have to ensure a proper or desired economic growth, then we have to check the money supply in the economy. See, the money supply cannot be more than the desired, and also money supply cannot be less than what is desired. All right, now who controls this money supply? This money supply is controlled by the Reserve Bank of India, RBI. To control the money supply, which eventually controls the inflation or which eventually ensures economic growth, is done by the RBI, and the RBI it prepares a policy for that which is known as the monetary policy. So monetary policy is basically a framework which uses many tools to control the money supply. All right, whatever is the situation of the economy, depending on that, the money supply will be controlled. Now, if you look into the definition, the monetary policy, they are tools used by the central bank, that is, in case of India, it is RBI, to manage the overall money supply and interest rates. Then now, how money supply will be controlled? Money supply will be controlled by uh, manipulating with the interest rates. I may not use the word manipulate, by playing with the interest rates. Eventually, we will come to know about the repo rate, standing deposit facility, marginal standing facility, CRR, SLR. These are certain tools of the monetary policy framework. So, repo rate or SDF, they are certain interest rates which are controlled by the RBI, and money supply is scattered likewise. Now, what is the responsibility of RBI in India? The RBI has to manage the monetary policy in accordance with the Reserve Bank of India Act 1934. That you have to remember. Which Act? 1934. And what is the primary objective? Remember these two key terms. The primary objective of the monetary policy or RBI is economic growth economic growth along with price stability. Economic growth along with price stability. All right. That means not only just controlling inflation, it has to control the economic growth also. So these 2 points can also be a possible question. Now, India's monetary policy framework. The RBI Act 1934 amended in 2016. What happened in 2016? By this act, between RBI and Government of India, the RBI got some exclusive power to maintain the money supply in India. Let me repeat. By this particular act, the act was passed. The name of the act was Framework Act of Monetary Policy Committee 2016. By this act between Government of India and RBI, RBI was vested with the exclusive power to deal with the inflation or money supply in India. Now, next, it has diverse objectives. Now you have to remember this. The Chakravarti Committee highlights that India's monetary policy must balance several goals. Okay, the Monetary Policy Committee, it shall the monetary policy shall balance several goals. There is not only one goal. Like I have said, economic growth, price stability. There it is. Price stability, economic growth, equity, social justice, and supporting new financial venture. Okay, this can also come in MCQ format. Which of the following are the goals of monetary policy committee? Okay. Next, inflation is used as an anchor. That means how the money supply will be controlled by targeting the inflation. Here comes the concept of inflation targeting. Inflation targeting. Now, what is the target of inflation in India? That is 4%. The RBI will try to maintain the inflation in India to 4% or close to 4%. Along with this 4%, a band is also attached, that is plus minus 2%. That means the RBI will try to keep the inflation rate close to 4%, that shall not decrease below 2% and shall not increase above 6%. So we can say the inflation targeting band is 2% to 6%. Between these two percentages, the inflation must be there and very, very close to 4%. So the Urjit Patel report or the Urjit Patel committee. So which committee suggested this inflation target? That is the Urjit Patel committee supports using inflation as the primary focus of monetary policy. It recommends setting a 4% inflation target with a tolerance band of plus minus 2%. That's what I have said just now. Next, the inflation target. The central government with RBI input sets the inflation target. Okay. Now, when I say 4%, that the 4% that is written. Now, in one of our videos, we have seen there were many methods to calculate the inflation. So 4%, when we say 4% and mention nothing, that automatically becomes the consumer price index, not wholesale price index, no producer price index, nothing. It automatically means the consumer price index. So we say the consumer price index is the primary uh, index that is taken for the calculation of inflation in India. Okay. Now there is another policy known as the fiscal policy, which is which also ensures India's economic growth, India's development. Now we will here in this table, we will differentiate the difference between monetary policy and fiscal policy. Like the first difference, I will say the monetary policy is under Reserve Bank of India. The policy undertaken by the Reserve Bank of India to ensure economic growth and inflation control is monetary policy. Now, if government of India has taken or another policy, because government of India also gives money into the economy and it prepares a budget, right? So that is the fiscal policy. In fiscal policy, there we study about tax, we study about government spending, we study about the budget. Okay, so you can see here in monetary policy, the whole money supply is dealt by catering to the interest rates. While in fiscal policy, we talk about the tax and government spending. Now, when we say tax, it can be DT, that is direct tax, or it can be IDT, that is indirect taxes. Next, what is the effect? Monetary policy, the effect is cost of borrowing by like when interest rates are increased, when RBI will increase the interest rates, that means it will be costlier for the commercial banks to borrow from RBI. And eventually, when commercial banks will also lend the money to the borrowers, to the market, it will be costly. That means when interest rates are higher, the cost of borrowing are higher. So what happens? The loan or borrowings falls and inflation gets controlled because money supply will be decreased. Now, in fiscal policy, it is controlled by using the budget deficit. Distribution. Higher interest rates hit homeowners but benefit savers. What happens ki when interest rates are increased, it hit the homeowners but benefits the savers. Those who are homeowners, those who have taken the loan to purchase a home, they are that affect them, but it benefits the saver, the one who saves money. And fiscal policy depends which taxes you raise. It depends on what tax the government is raising. If government is raising indirect tax, say for example GST, if government has raised the GST, that means it will impact the normal consumers, people. And if government is increasing the direct tax, it will not directly hamper it, but eventually at a certain point of time that will fall on uh, the taxpayer. Next, exchange rate. High interest rate cause appreciation. What does this mean? When interest rates are higher, increased by the RBI, that causes appreciation of the rupee. No effect on exchange rate. That does not affect on exchange rate. Supply side, limited impact. And in fiscal policy, higher taxes may affect incentives to work. Politics. Monetary policy set by independent central bank. The monetary policy that we are talking about, that is very much independent. That RBI is solely authorized to do it. But in case of fiscal policy, changing tax and government spending is highly political because it is dependent on the parliament. It is dependent on the legislatures. Next, if we see liquidity trap. Now, what do we mean by this term liquidity? Liquidity, the term liquidity means availability of cash. Availability of cash. When interest rates are cut, then liquidity will increase. Cuts in interest rates may not work in liquidity trap. Fiscal policy advised in very deep recessions. Okay. Now we will talk about the Monetary Policy Committee. When we talk about committee, that means what do we mean? We mean the people who will be the people who will be taking the decisions of in the monetary for the monetary policy. So there to exercise that policy, a monetary policy is formed under the same agreement, that is agreement on monetary policy framework. This committee is a six-member committee which is established by the RBI Act. Alright, now this six-member committee, three members are from RBI and three members are Government of India officials. And among these three members, one member is the chairman of the MPC, and that chairman will be the governor of the RBI. Alright, that chairman will be the governor of the RBI. Now, all the decisions are taken by voting. Suppose any interest rate has to be increased. In that decision, everyone has to vote. Okay? Sometimes there can be a voting of 3 is to 3. RBI officials are saying yes, three of them are saying yes, and three government officials are saying no. So that is in tie. So in case of such tie, what happens? In case of such tie, the governor, who is the ex officio chairman of MPC, he has the governor or the ex officio chairman of Monetary Policy Committee, he has a casting vote. He has a casting vote, means it is an extra vote. So definitely the governor or the chairman of MPC will favor which, where here only, because already one vote he has already exercised. But in case of tie, he has one extra vote, so definitely he will give here. So it will become 4 is to 3. Hence the decision of RBI or Monetary Policy Committee will be in the favor of RBI and not government. Hence, it is said that the Reserve Bank of India has been solely authorized in case of monetary policy. Now, if we see here, in case of failure to maintain the inflation target, that if we talk about the 4% with a band of plus minus 2%, then what will happen? Now, what does the definition of failure? That 2% to 6%, that band is not met. Maybe less than 2% or more than 6%, say 7% or whatsoever. For 3 consecutive quarters, then this can mean inflation being consistently too high or too low. Then what is the responsibility of RBI? The inflation target is missed. The RBI must submit a report to the central government. If the target is missed, then RBI must report this to the central government, that why the target was missed. Second, proposed actions to correct the situation. They have to answer the government what are the actions that will be taken to correct the situation. Next, estimated timeline for returning inflation to within the target range. Okay, how much time will be required to get back to the target once again? That must be reported to the government soon, as soon as possible. Next, monetary policy operating framework. Aligning with the weighted average call rate with the policy repo rate through active liquidity management. Here is the goal. The call rate or repo rate we will be bringing in some other video. Let's talk it in a very bird's eye view manner. Aligning with the weighted average call rate means it is one of the interest rate. The repo rate and the weighted average call rate shall align. Now, what are this? That we will post in some other video. Purpose: facilitate the transmission of interest rate changes throughout the financial system, influencing aggregate demand. Let's see, we will discuss that in a separate video because that is very much technical. But now we will just take a mota idea of that monetary policy. Concerns regarding inflation targeting in India. What is the concern that the model underlying inflation targeting assumes inflation arises from economic overeating and is cured by raising interest? For our understanding, we will just require what is this overeating. Here, the word mentioned overeating means that the economic growth is too high. When production is more what is desired, or when the not desired, but when demand is very high, that must be in that particular point of time That is known as overeating. All right, more than desired demand is overeating. So due to that, inflation takes place. All right. So here you can see whatever I have talked about the monetary policy committee. It is a six-member committee established by central government under the amended RBI Act. It includes It includes RBI governor, the chairperson, who is also the member, RBI deputy governor in charge of monetary policy, and one RBI officer. So this is the three-member and three external experts appointed by the government. That is three-member. Okay. Now, what are the requirement? The monetary policy shall meet at least four times per year. At least four times per year. It can be more. Quorum of four members required for decisions. At least in that meeting there must be minimum four members. In case of a tie, the RBI governor has the deciding vote. That I have told you. Each member provides a written statement explaining their vote. Each and every member in the committee vote and must explain and justify the voting in the particular favor. All right. So this is something about monetary policy committee. In the next video, in the next class, we will bring the tools of monetary policy committee, where we will read about the quantitative tools, we'll read about the qualitative tools. There we'll read about repo, reverse repo, SDF, MSF, CRR, SLR, OMO. All right. So stay tuned to watch the classes regularly. So thank you once again. Jai Hind.